I bought a company for 15 million on a deferred basis. I put pretty much all the money I had at the time into buying it.
Which was?
It's about 1.325 million. And then COVID hit, and my de-risk clever idea where I didn't need third-party capital suddenly looked very stupid.
Was that always on the cards, wanting to set up your own business?
Michael's used to joke in the office that when Anthony leaves in 2029 at the bottom of the cycle and, with more of a track record. So yes, I think it was always on the cards, probably a lot earlier than I thought it would ever happen. I called the GRI and said, is there any chance I could come as a student to listen? To which they said, no one's ever done that before, but if you pay €1,000 to come, sure, why not? So from that trip, I then realized, right, I need to try and position myself to be on that journey. And the place to start with that is going to the US for university.
Anthony, welcome to the People Property Place podcast.
Thank you for having me, Matt. Great to be here.
Not at all. It's a real pleasure and a privilege. I think it's been quite a long time coming. So thank you so much for carving out some time in your busy diary.
Thank you for being persistent and asking me to come. And hopefully I've got some more to talk about now.
I love profiling young entrepreneurs on the podcast, and you've had a phenomenal track record since you set the business up. So I'm really excited to dive into a little bit about the business, how and why you set it up, and obviously go through some of the business deals that you've done, plans and views on the market as well. But before we get on to Valorem, can you just throw your mind back and tell me, did real estate choose you or did you choose real estate?
I think it definitely chose me. Without sounding too boring, my dad had a career in property, and growing up, he'd probably arrange every lunch or meal out around a site visit that he didn't tell us about. So we would look at all sorts of sites, buildings that he was looking at the time, and then we'd have a sort of debrief in his office afterwards from a very young age. And so I suppose my childhood was actually 18 years of site visits without me realizing.
So you were destined to follow suit?
I think so. I mean, actually, when I was younger, probably at sort of 10, 11, I actually really wanted to be an architect. And then someone told me that, you have to spend 4 or 5 years studying, and you're actually pretty crap at drawing. So that's not going to be a great start.
So focus on another part of the real estate space. What part was your dad in?
So dad, in the 70s, 80s, 90s, had a public company doing office developments in the city mostly. And he was doing refurbishments, leasing, selling.
So you were kind of always exposed to that, and to the writing was on the wall in terms of maybe getting into the industry. As a kid kind of growing up, what type of kid were you? You obviously touched on the fact that maybe drawing wasn't maybe a strength.
I suppose a school report, I remember getting back from school and, my parents would get me into their sort of office and quiz me about the school reports. And there was a report from my headmaster at the time that said, if Anthony spent as much time in the library as he did on the sports pitch, we might have an academic on our hands. So I definitely wasn't top of the science class, but I was very determined, always worked very hard, and had great friends along the way.
So, yeah, a successful career in real estate beckoned. If I'm not mistaken, you studied it officially in the US. Talk to me about how that came about.
Well, the US concept came about initially. I was working in the summer when I was 17 at home for some extra money, working for a guy who had a pig roasting business, and I saved up a couple of grand over the summer. And I'd been scrolling through all the property press about where I might be able to do my next internship or work experience. And I came across this Paris GRI conference in October. So I called them with a amazing panel of speakers that I would have loved to have chatted to or listened to. And I called the GRI and said, is there any chance I could come as a student to listen? To which they said, no one's ever done that before, but if you pay €1,000 to come, sure, why not?
I mean, I know the GRI is, is very expensive, maybe 5 7, 10 grand to kind of go. The fact that they wanted £1,000 from you,
I know.
it's still crazy as a
tight,
student.
yeah.
Yeah, exactly. Just for like a day's conference. So they said if you pay £1,000, you can come along.
Yeah, so I paid half my pig roasting money and went along to the GRI conference, and it was just full of phenomenal industry leaders. I mean, I remember there was one guy called Anton Bilton, whose family were sort of big infrastructure developers in the UK. They built a lot of the UK's railroads. And I sat on a panel listening to him, and he was talking about how he pivoted out of infrastructure to building an industrial platform in Russia called Raven Russia with his partner Glyn Hirsch, and how they just spotted an opportunity and like totally, changed what they were doing. Alongside, listening to like the head of Blackstone or Carlyle about £100 million building they just bought. And I was kind of like hooked. I thought this was amazing, and they were kind of just fascinating people to listen to. And I really tried to get the ear of anyone who would listen to me at the event. And I met one man who spent an hour talking to me when I was 17, 18 at the time. And he really took the time to explain what he did. He had a family office that he'd sort of started from scratch. And one thing that I noticed, having looked at all the CVs of everyone, is that they had the most impressive CVs of, Penn, Harvard, Wharton, worked at, any investment bank that we'd all recognize. So from that trip, I then realized, right, I need to try and position myself to be on that journey. And the place to start with that is going to the US for university.
Wow, what an incredible story. I don't think I've heard any 17, 18-year-old, not that I talk to many, take that initiative, but also that financial commitment to put their money where their mouth is and actually go to an international conference and spend time listening to some CEOs and leaders talk about their background journey and where the opportunity set is. But that makes a lot of sense in terms of looking at their CVs and kind of thinking, if that's what I want to do in the future, then let's try and reverse engineer it and get in at the university door and set myself on that.
I didn't end up doing any of that, but
you didn't?
Not really, but we'll come on to it.
So the America thing came in.
So I realized I kind of wanted to or needed to go to an American university to kind of get that footing potentially. UPenn in Philadelphia was kind of the best place to do that. They had a lecturer there called Dr. Peter Linneman, and through a friend who was also looking at going to US universities, colleges, we went on a tour of the US, and we went to Penn, and I met with this lecturer, and he very kindly offered a year's internship during finishing school and starting university. So I did my SATs at school, was looking to get a place at Penn, and then was offered this phenomenal opportunity to go and work for the lecturer of the course I was going to be doing. He also had a family office that he ran doing land investments throughout the US. So I moved to the US after school, was paired up with a guy from the office to live with called Anoop Dave, who sort of became a bit of a mentor to me. And I followed around Peter Linneman, went to his lectures, and in the evening when living with Anoop, who was working for another real estate business, would have a crash course in development and all that sort of stuff.
So rather than kind of go to Thailand or Africa or the classic gap year, you decided to go and do a year's internship effectively in the US, learning from a lecturer some of the theory behind the real estate private equity investment management industry, but also having a crash course from your housemate effectively, who was actually on the tools doing deals in his current role.
Exactly. Yeah.
And so what are some of your reflections or learnings from that kind of year in the US?
I mean, firstly, I was surrounded by incredibly bright, interesting people. It was also 2009, so it was a very interesting time to see how wrong it can go. I suppose the overriding point was everyone was very driven. Everyone was very interested. Even though I was 18 and didn't have a huge amount to say, a benefit to them, they were also very interested while I was there. I remember getting in the lift on the first day, and I was in my suit and tie, like right first day of work, and the lady got into the lift. She said, "Oh, is it your first day? Are you here or are you here for an interview?" I said, "No, I'm doing an internship." Said, "Oh, you're English, I understand." I had a great time, and it was just a steep learning curve, really. Yeah.
And that cemented that real estate private equity investment management is actually what you want to do.
Yes. Yeah.
How did you kind of take that forward at the end of the year? What were you thinking, and how did you progress that experience?
So I was meant to be starting Penn. My dad suddenly got very ill, had a heart attack, had a quadruple heart bypass, which was a shock. And also it was in 2009. He worked in property and he was having a pretty tough time financially. So for family reasons, I didn't end up going to Penn, which at the time I was pretty gutted about. But I got a last minute place to go to Reading. Arrived at Reading on the back of this high in America. And instead of looking at financial models and buildings and project meetings, I was out on the lash eating pizza, which was great for a week or so, but wore pretty thin quickly. And I thought, I'm never going to last 3 years here. So I spent a few weeks calling around as many people as I knew to like some ideas. And a Noop who I lived with in Philadelphia said, well, a good friend of mine from Penn called Michael Kovacs and his business partner, Brandon Holohan, are leaving Westbrook. Why don't you go and have a chat with them? They're 27. Mike was always a very bright guy at school. See what they've got to say. So went to London, met Mike. He said something along the lines of, look, we don't really have any money, but we've got really great institutional training. Mike had been at Blackstone, Westbrook, Brandon had been at Morgan Stanley, then Westbrook. And so I suppose from my perspective, they were the people that I wanted to hang around with, learn from, if I'd gone to the US, who I kind of wanted to be. So I did everything I could to hang on their coattails. And over time, they basically offered me a job. So while I was working at Reading, I ended up, whilst I was meant to be studying at Reading, I was working in London with Mike and Brandon, and it was a startup. So I was mucking in with everything. There was, at the time, it was Mike and Brandon, a man called Martin Clace, who now works with me at Valorem, who ran all the development asset management work. And I kind of just mucked in doing everything.
So just to get this right, you were at Reading University, and after a week or two, you thought, culturally, this doesn't seem like the place that I really want to be. You've obviously got quite a lot of stuff going on in your personal life that you need to deal with, but it was kind of a real gear shift from maybe the aspirations you had in terms of Penn and the opportunity and the kind of the higher octane driven environment. So you got connected to Mike and Brandon, and you effectively were having a job as kind of a junior intern analyst type, which was full time, and then doing your studies on the side at Reading. Yeah,
exactly. I mean, I'll always be grateful to Mike and Brandon for the opportunity they gave me. They invested a lot of time in me and teaching me a lot of things. And it was great fun. It was like the dream job. I was out there with two really bright guys in a market where we were buying really exciting deals. So I sort of, would have to pinch myself at times and be like, this is exactly what I wanted to do. Very strange way of it all getting there, but here I am.
And you were paid to do it rather than it wasn't like a free internship or what have you.
So initially I wasn't paid. And then as the role evolved and we bought buildings and, I probably became more use, and then I would start originating deals myself. It kind of naturally turned into a job. And I remember at some point sitting down with Mike and Brandon saying, look, I actually kind of need some money. And they were very generous in a salary they gave me. And that meant the world at the time. And it was great.
And you finished your studies at Reading?
I did finish my studies. So I got a 2-1. Not quite sure how, but probably because my dissertation was based on a investment memo on a building we were buying. So my tutor didn't really have much of a reason to question it when I told him it was a real asset.
Yeah.
So that was fun. And because I was learning so much on the job, actually reading some of the work was very relevant because what I was doing in practice, you were learning the theory at the same time. It was a great time.
And in terms of that kind of role, were you just like a junior analyst, underwriting deals, screening deals, and were you just kind of just doing a bit of anything and everything, depending on where Mike and Brandon were in terms of trying to raise capital, put decks together, talk to agents? Was it just a bit of a crash course in scrappy entrepreneurial startup?
It was a bit of everything, partly because it was a startup, partly because I didn't have much of a skill set. Mike and Brandon sent me on a financial modeling course, which I spent, ages learning all that. And Martin, who's sort of head of development asset management, I would go along to all the meetings with him and slowly learn on the job on all the developments we were doing. So it was a bit of everything. And then I suppose as time went on, I carved my own role in the business of originating deals and spent a lot of time with investors. So I was kind of like the English guy running around the market, finding deals.
So for someone listening to this, what do you think that Mike and Brandon identified in you that they said, we want Anthony on the team rather than not?
I think I was pretty persistent, so I'm not really sure I gave them an opportunity to tell me to leave. I probably worked for 6 to 12 months pretty solidly with not making any money. But I did it because I wanted exposure to that world, and I learned a huge amount from them, and it was fun as well. And then, ended up delivering a couple of interesting deals. So I think I earned my place in the team over time, but initially, I don't know.
Was that drive and resilience and the ability to, I guess, work for free in exchange of like learning from them?
Yeah, and also massive thanks and credit to both of them for allowing me to do it and putting their arm around me and teaching me a lot. So
post-Reading, you got your 2-1. You landed full-time officially at Castleforge?
Well, in those days, so that was sort of like 2010, 11, 12, Mike and Brandon were still doing deal-by-deal investments under a brand called Mercer Real Estate Partners, where it was sort of clubbed together some friends and family money alongside PE funds or family offices, buying buildings off £200 to £300 per vacant, and building up a track record that way. So we were still deal by deal. We didn't have a fund. It was like find the deal, find the money, but very much applying their institutional underwriting presentation capability in that process. On the back of that track record, which was, call it 2010 to 15, we'd done some phenomenal deals. That a standout deal that comes to mind was bought a building out of receivership on Aldersgate Street, 160 Aldersgate, paid I think £350 a foot with Cameron McKenna still in. Mike managed to get DLA Piper on to a pre-let, which then Martin built out 250,000 square feet to the world's largest law firm. So it was a real moment where it had gone from a few nice deals to actually this is a proper business that is delivering real returns, competing with some of the biggest players in the market.
And as such, needed to evolve, institutionalize, or change tack in order to keep up with demand, or where the opportunity was?
I think at the time we were backed by a couple of family offices. I think Mercer could have carried on in that structure and would have done very well. But I think Mike and Brandon, coming from that private equity background, had ambitions to leverage that track record and become discretionary fund managers. So they appointed a placement agent called APC, and we got rebranded to become Castleforge, and we went from 5 or 6 people to 20 people, and they successfully raised 230 million of equity in 2015. And then we started investing that into the regional markets on the back of the growth from London that then rippled out. It was a real moment in time where, as Mercer, we were a small business making really great money and there's a lot of fun to we were now institutional in everything. And the team changed a lot. It was in some ways nice not to have to go and raise the money for each deal. And I suppose there was an element of security that there was management fee income raised that meant we all knew that we were going to be paid for the next, 7 years. But it definitely changed the dynamic of the business. Yeah.
And it was at that stage you decided to leave?
When the fund was raised, my role was very much running around buying buildings throughout the UK, which again was phenomenal because I had a checkbook to go and do really interesting deals in a market that was still, maybe capital constrained. Prior to raising the fund, one of the family offices that had backed the Mercer deals, I'd done some land deals with outside of the Mercer structure, which Mike and Brandon were both co-investors in. And I got to know that family office very well because I was the one running around buying deals, and we also had these other land deals on a separate account. And the head of that family office said to me, I get the impression you're not enamored by the fund structure, and maybe you're better placed in a more entrepreneurial business that, why don't you go and do that yourself? So that was in early 17. And it was probably earlier than I thought I would do that. But, it was a great compliment from the family office and I suppose music to my ears at the time. I said that's what gave me the confidence to leave and set up.
Was that always on the cards, wanting to set up your own business?
Mike always used to joke in the office that when Anthony leaves in 2029 at the bottom of the cycle and with more of a track record, so I think it was probably always on the cards. Looking back, I would have loved the idea of being partners with Mike and Brandon, but they very much forged their own business themselves, and I think everyone has to do that to really own their own business. So yes, I think it was always on the cards, probably a lot earlier than I thought it would ever happen.
But great circumstances in terms of capital coming to you and saying, look, there's been a change, there's an opportunity, we like working with you, you've done some interesting deals, good partners, can we work with you in a capacity that might work for you, given the fact there's been a change in the Castleforge business and structure and direction? Were they quite aggressive in terms of the structures and wanting to take a part of the top co, or how did you negotiate that and actually set the business up?
Well, without realizing, I'd had the benefit of seeing Mike and Brandon set up Mercer, and then that track record, and then going in, becoming institutional with the fund, and all of the structures along the way with different co-investors and family offices and PE funds. So I'd learned quite a lot in structuring. I knew that as a young startup, probably any family office would want to get their pound of flesh, and generally they want part of your business for providing that seed capital to build up track record. But I wasn't under pressure to do that, and also they'd approached me, so I resisted that pretty heavily. And with credit to the family office, the UBO said, "Look, I think you're probably past that. So why don't we just do some great deals together?"
So it enabled you to literally set up without having an external shareholder, but having kind of capital and a supportive partner to go out and do interesting deals.
Yeah, so I had a family office that I knew really well. I'd made money for in the past. They were very opportunistic in their approach to real estate, not so thematic. So it was very nice to know that I had a backstop of a family office. Whether they were going to put all the money up for deals was yet to be seen. They might put some of the co-investment up for me to go and pair with other investors. But when I left, I was 27, and even though a difficult thing if you've been working in a business and you feel like you've done a lot within it, it's still not your track record. And so if you go and sit in front of a new investor when you set up your own business and someone says, "Tell me about your track record," and you repeat the business you've just left, that's not your track record. So it meant a lot that I had the backing of the family office so that I had a bit more credibility when I was doing that.
What was the kind of the business plan, the idea the types of deals you were going to look at, and how rigid were you in terms of that plan and that structure versus being opportunistic?
When I left in 2017, I felt that we were getting towards the top of the market. We had,
from an officer's perspective, or just generally?
I felt generally, but my most of my context was in offices. So deals that we'd done in the early Mercer days, for example, building on Hammersmith Road, 80 Hammersmith. That building had been, we'd rebought it, refurbished it, sold it. That had been sold 2 or 3 times over by the time I left in 2017. Everyone had made money on the way through, which naturally feels, we have that mixed feelings. Oh, did we sell too early? But we made good money, so move it on. How can an asset just keep making more money for the different people? At some point, the music has to stop. And having started my career, call it in 2009-10, you remember how, even though I wasn't an investor at that time, you remember how tough that was, and that could easily happen again. So I didn't think there was a particular theme. I think it was very much opportunity-led.
Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. Some of the founders that have been on the podcast before, who've been backed by businesses, talk to the pressure of having to deploy capital to generate a fee stream. And it's that chicken and egg, and it's that balance between, we need to do deals to get a fee stream in to support what we're doing, but it's that tension between doing the first deal and the best deal or the right deal and protecting your track record. How did you reconcile that? And how did you navigate your kind of the first deal?
I was somewhat lucky in that I didn't have as much pressure financially as a business to begin with. I alluded to earlier, I had a couple of land deals with this family office already under management. So when I left, I had the benefit of those deals and the management fees that came with them. I also quite early on in setting up the business, I bought and sold a land site and made good money out of it. So I had a cushion early in the business to breathe and not do something that is against your philosophy on investment. So I didn't expect to do anything that quickly. The first deal I did, having set up, was actually an office deal in Dublin. A contractor who had done a lot of our fit out work in the Castleforge Mercer days, a guy called Paul McKenna at Mac Construction. He said to me, look, with all your experience in the UK, you've got to come over to Dublin. What's happening over here is unbelievable. The tech take-up's huge. There was something like 3 or 4 million square feet of net new take-up every year for a few years. Prime rents had got to 60, out of town was at 25, and there was nothing in between. So went over there, identified a site in a probably an emerging location where you could buy the land, a quarter of what you could in prime, and then your build costs would be the same, but you don't have to lease up to 60. You'd make great money at 40. So I actually spent the whole of 17 working on that one deal. Did tons of research on it, spent tons of time in Dublin, which is great, by the way. And got into a real hole in diligence costs, where, I was probably 150 grand in a hole. Although I'd made some money, I didn't want to go and spend it all on one abortive deal at the outset. And I bumped into a friend called Roddy McPhee, who has a capital raising business, RDM Capital. And he said, oh, you've got to meet Acoustics, this Greek family office. It's the kind of thing they'd really like to do. And I know they're looking to invest in Dublin. So Roddy introduced me to acoustics. We spent a couple of months in diligence, and we ended up doing a deal together, which was a real turning point for me because it was a new family office in a new geography on a ground up development that we'd never done previously, even with someone else's track record. So it gave me a lot of confidence as a founder.
27-year-old founder.
Yeah, I managed to convince someone to do that. That then enabled me to hire Martin out of Castleforge, who works with me today. So I then had the experience of Martin to the business and could justify having him. So that was a real kind of turning point in that.
So that was your first landmark office development ground up deal, and you exited that for a healthy profit, did you?
So we started construction in 2018, knocking down the existing building. We were half built when COVID hit on a 90,000 square foot office. And in Ireland, they legally shut down construction. So I remember looking at this camera on my laptop and my in-laws on a farm, thinking like, what the hell am I going to do? I've got a half built office. Every newspaper article says offices are dead. Anyway,
that's my track record done.
Yeah, it's like, geez, first deal. And we had a bit of luck that Martin, in his wisdom, he claims he realized it was in there, had included a malicious virus clause in our build contract.
Get out of here.
And I said, look, we've got to come up with some idea here, Martin. We can't just sit here looking at this half-built site that, we've got all our investors' money in it, and I had a large co-invest in it as well. And long story short, we got paid out in full in a very short period of time for all of our delay and damage costs for COVID, because in Ireland, they legally shut construction versus the UK, they didn't. So it was...
and you had this malicious virus clause in the contract.
It was unbelievable.
Just by chance.
Yeah. So we got lucky on that. COVID then, did what it did, and we PC'd the building. We let up 30% of the space above underwriting. I think it was like 49 euros a foot, and it was just interest rates hadn't started to push out yet, so we were a bit behind on costs on time, but we'd been compensated with the malicious virus clause. We'd leased up above underwriting. I thought, right, now we just need to get out of this thing. And that was probably early 22 where we had that discussion. It took probably 4 to 6 months to get everyone on board with doing that. And we marketed it through CBRE, and we ended up selling it to Patrizia in September 22, which was probably 1 minute past midnight on Liz Truss and the market, and we got chipped. I was looking at your podcasts last couple of days. I noticed Phil Irons was one of your...
He has been on the podcast, yeah.
And Phil was on the other side of this deal. And I remember he chipped us the day of the deal going through, and he didn't... I was waiting for the call, like when we're going to get chipped. And then he chipped us, and we accepted the chip and moved on. And it's now that I don't know if it's still their asset, but it's not ours.
And I remember meeting Phil at Patrizia, catch up as we often did, and he took the phone call in the meeting because he was like, we're doing this deal, and I was like, what deal are you doing? And he wouldn't tell me, but he's doing this deal, and he was talking to the lawyer about the chip. And I was literally in the room in the boardroom of Patrizia's office, on Sloane Street, but I had no idea that it was you on the other side. So, it's so funny how it all comes around. And obviously, Phil has been on the podcast and is a great investor, no longer at Patrizia, currently consulting for Oryx, which Johan has been on the podcast with as well. But it's funny how small a world it is. So you managed to get out of that just before Kwasi and Liz Truss sent the market into turmoil. So offices... Irish office, how did you then kind of build and scale the business? Because as a firm, you're not just exposed to offices, you've got other sectors that you play in as well. Yeah, so at the time of doing the office, we were also investing in quite a few land deals. Going back to the early Mercer days, at that time, I forgot to mention, we raised 120 million from two family offices to go and buy brownfield land sites in the regions at a time where you couldn't really justify building. And
So it was an interesting and clever land play, which Mike Kovacs came up with. And when I left the business, one of the family offices that backed me had a share of these assets, and I ended up buying one of the assets, which was a Liverpool asset. It was about 4 acres opposite the Albert Docks, best site in Liverpool by far. Or at least I thought so at the time, until it got very complicated. And I bought a company for 15 million on a deferred basis. I put pretty much all the money I had at the time into buying it.
Which was?
It's about 1.325 million. About
1.325 million,
Yeah.
all of the money you had into that deal.
Yeah. And the reason I did it is I'd structured it. Well, I suppose I had the comfort that the family office who was backing me was part of the vendor's equity. So, hopefully it wasn't going to be screwed over too badly if there were any problems. But when I did it, I had a hotel tenant on a 35-year agreement for lease and forward funding lined up for a lot of the residential. It had consent for, I think it was 700 residential units, and we converted one of the blocks to a hotel consent for 270 keys. Got Mackley and Rush on board to build it out. Had M&G on forward funding, and then COVID hit, and my de-risk clever idea, where I didn't need third-party capital, suddenly looked very stupid. And I was then living the reality of your own investment committee. So that was challenging. But we, after lots of restructuring through COVID, an unhappy girlfriend at the time when we were on holiday, restructuring all of this stuff.
Saying, you did what?
Yeah.
You put that much money into a
I
deal?
thought we were buying a house.
Yeah.
No, we bought a company in Liverpool, which we might now lose all of it.
Yeah. We're on a very nice holiday because I'm going to have to put on a credit card to fill that payment
it was
as well.
an expensive holiday. I think I was probably spending the money I hadn't made, which is also a very common developer problem, a lesson I did know. But there you go. No, I thought I'd created a really de-risk, clever deal. Killer virus takes over the planet, and there was no funding market. Had to restructure it. Thankfully, 18 months later, ended up forward funding it with Aviva, and we PC'd the hotel last year. So very stressful, but good outcome in the end. Also nice on the track record to be doing forward funding with an institution like Aviva in a sector we also hadn't done anything. So
and get out of it alive and make a little bit of money, and crucially learn some lessons along the way as well.
Learned a lot.
So you touched on kind of own investment committee there. From there, did you kind of try and institutionalize the business a little bit further with some external advisors, just with some kind of checks and balances and grey hair who'd been there and done that and been through various different cycles, just to help, counteract maybe, or kind of hold a bit more counsel up to your thought process?
I mean, I'd implemented the institutional approach from Mercer and Castleforge, and whenever we were doing deals, we would, write all the investment memos, upsides, downsides, risks, all of that. Strangely, with my own money, I didn't do that. I suppose because I was just so clear in my head about what we were doing. And frankly, if COVID hadn't happened, we would have done really well, and the forward funding would have happened, and we probably would have made a fortune. And I don't know, I wouldn't have learned the lessons I've learned, but I'd probably have more money today because of it. So I think, Martin in the office, he's early 60s. Forgive me for saying that, Martin. He's been around the block a bit, and Martin also co-invested in the deal with me. So I think we did everything we could. I think there were a lot of people who were put in a difficult position because of COVID, and strangely enough, no one had killer virus in their memo.
Yeah,
but
no insurance on that one.
Yeah, but it definitely was a lesson that I think of today, that there's always more risk in any deal. You can't underwrite everything. There'll always be things that come out of nowhere that change your plans.
How do you account for that, or how do you underwrite against that?
Probably looking back to a lot I learned from Mike Kovacs. He always used to talk about buying below replacement cost. So if you're if it costs you £500 to be in on an office building, all said and done, we bought the land, financed it, built it, etc. If you're buying well below replacement cost in a supply constrained market, you're probably in a good spot, or at least you're in a better spot than a lot of people. So I always look at our basis, and if we can be below replacement cost in any sector, that's what we try to do.
So you've done a couple of deals, and you've got out of them alive through a rather challenging macroeconomic backdrop. How did you evolve the business? How did you grow the business, bring in better or bring in people, but also expand the capital base as well?
Well, the people one was easy because you helped me with that. You introduced me to Adam Robinson and my team, who's phenomenal, and I'm very grateful for that. How do we evolve the business? We'd also done some other land deals, which I haven't mentioned, where we had some great exits on some high multiple, 5 times your money, where I ended up making good promotes, and so that gave me a part of capital personally to co-invest in deals with other investors, versus the usual question of how much are you going to co-invest, and you're thinking, well, I've got a girlfriend or wife who wants a house. I've got a team that would love big bonuses.
Can we roll up the fees in it?
Yeah. No, I suppose that there's always that slight hesitation or risk that as a young property investor or investor, you want to be seen to be putting skin in the game, which I totally agree with. It's just more, you can be stretched. So I guess looking at 2022, having sold a few assets, it was the first time I had a proper pot of money to invest alongside third-party investors. So we spent quite a lot of time meeting with new investors on the back of the track record we just created selling assets in 2022. And we got a lot of traction. It was very nice to be able to sit in front of investors with a track record that was mine, versus talking about things you own that you hadn't exited. And I thought we were going to have an amazing time buying interesting assets, post interest rates, and I thought there'd be lots of opportunity. And obviously the next question from investors is, well, it's really nice and well done, that's a nice track record and nice team, but what are we here to talk about? Where's the deal? And that probably summarizes the last couple of years, where it's just been a very frustrating 2 years in a market that's been very stagnant. If you've got money, you don't want to buy at the prices that are there because they haven't really dropped. And if you own assets, you don't want to sell them because you probably get your pants pulled down. So I think the last 2 years has been frustrating on a deal perspective, but it was time well spent meeting investors, being patient, not investing, because you get twitchy, or as you said earlier, always like some more fees. And I felt very fortunate that we had sold out of assets that if we hadn't done, they would be problems. And yeah, it was a nice place to be.
So from a timing perspective, you've done some deals, kind of given yourself and investors confidence that you can deploy and return with profit capital, build your own track record, but also be in the fortunate position where you've kind of built up a bit of a buffer, co-invest pot. The challenge is then finding the next deal, and it's about being disciplined and being ruthless with protecting your track record and doing the types of deals that you should be doing, rather than just trying to put money out of the door, which I guess some investors who've raised a discretionary fund on a 3, 7, 10-year type horizon, they really feel that pressure to kind of actually deploy it. You're in a fortunate position where you could actually be quite discerning in terms of how you allocated that, get around the market, talk to a lot of people, but maybe not transact as much as you would like to.
Yeah, I think that's probably a similar story for a lot of investors, a lot of people in our industry the last few years. I think because we couldn't see any obvious opportunity in most sectors of property, we spent a lot of time scratching our heads of like, what are we going to do? And we looked at dozens of deals. We ended up putting a couple under offer that, because you just get a bit frustrated, and then we withdrew on a couple, and I thought, right, enough of that. Let's just bide our time, and then when we really believe in something, we'll go for it. And it's been a very difficult couple of years for value add investors. I'm very excited that we've recently signed up a new JV with a family office to do core plus London assets, office assets. We bought our first building in this new JV in September. We bought a building 1-5 Poland Street, off market, 15% below the valuation the vendor had, through the capability of the family office we've JV with, we managed to buy it all cash in 10 days. And I think it's a great deal. And I think on a risk adjusted basis, to be in core plus where we should be able to hit a 12% IRR over a 3 to 5 year period, I'd far rather be doing that than trying to get a 20 to 25% IRR, take tons more risk, and really having to look at yourself in the mirror on your investment memo that you've written, trying to get it to a de-risked 20, which is very difficult.
How have you expanded that capital base? Is it just knocking on a lot of doors? Is it placement agents? Is it existing investors introducing you to their kind of friends and other family members? How have you gone about evolving that and getting in front of other investors?
Probably all of that. A lot of them have been just introductions, so other friends in the industry. Personally, I'm very open about introducing friends in the industry to investors or contacts I have, because I like to see friends in the industry succeed, and I think investors really like it, because if you're not sort of trying to be protective over them, and I'm also not, I'm not an expert at everything in property, far from it, and there are lots of people better at sectors than I am. And I think by doing that, you get a lot of reciprocation from friends in the industry. And so I've met a lot of investors through friends in the industry, through maybe my great friend and lawyer, Mercer, who he's acted for a lot of people. He said, why don't you go meet X, Y, and Z? And a lot's come from that. So it's a bit of word of mouth, bit of experience.
Paying it forward, playing the long game, doing what you say you'll do at the appropriate time.
A lot of coffee.
How, what's your kind of vision for the business, and how do you kind of build it and evolve it? And what's your kind of plan and thought process around how you do that?
So because we're opportunistic in quite a few sectors, I said earlier, we've done offices, hotels, land, industrial, student accommodation. One of the downsides of that is that we're too broad. And it's sometimes hard to be focused on any one thing, and you end up kind of jack of all trades, master of none, or agents literally have no idea what you are and what they should go and find for you. So I'd love to have, and actually the same goes for investors, because you sit in front of an investor and you talk about that track record, and they're like, well, which is it? Which is a fair comment. So I'd love to have segregated mandates for different strategies, whether that's land and planning deals, which are more high multiple, longer term deals, or value add deals, which is probably more opportunistic bucket, core plus strategy. So I'd love to basically put more structure around each theme, or maybe not theme, maybe more capital structure of the business. Businesses like Delancey have done that phenomenally well. And then family offices, have done that well, but they allocate internally. So it's just a different way of doing it.
Yeah. So you kind of have MDs or captains of a particular strategy who are responsible for raising and then deploying capital into those particular strategies.
Yeah. And I think part of that is, if you're a value add investor and that's your pigeonhole, there are plenty of times when you should just not be investing. And that's a very difficult thing to do as a young business, someone who likes doing deals. It's just, if you've got a few more strings to your bow where you can invest throughout the cycle in clever ways, that would be a lot of fun.
You obviously seen some of the journey just in terms of the Mercer Castleforge change, in terms of raising discretionary funds and that journey. Are there aspirations to raise a discretionary fund under the Valorem name?
Probably not, but never say never. I think if there was a theme that was compelling enough, and focused enough, then maybe. I don't think I'd ever want an opportunistic fund. But if they're, for example, we're looking at a sector at the moment, defence infrastructure in the UK, where we could hopefully create long-term income streams from government-backed tenants or things like BAE Systems or Leidos or business like that. And I think if you could create a fund which is that focused, then great, but not on an opportunistic basis.
It's obviously been an interesting few years to run a real estate investment development business. Is there anything that particularly keeps you up at night?
I suppose, other than my 3-year-old son, I suppose when you're investing in value-add assets or any asset, there's always things that are whirling around your head about, I need to do that. What happens if that happens? I forgot to call that person. So I've never had a problem getting to sleep, but I do find I wake up 3-4 in the morning and your head's going, and it's just generally everything that you need to be doing or thinking about. So I don't know. It's everything that comes with running a business, probably every owner of a business has.
How, in terms of the conversations you're having with family offices, because a lot of them kind of fund and work with you, have you had challenges in terms of family offices being over allocated to real estate already and they're allocating their capital elsewhere, or does that not really come up as a challenge?
Well, it's definitely come up in the last couple of years because real estate hasn't been that attractive a sector, partly because it hasn't rebased in value, but also there have been lower risk ways of getting a return than investing in real estate that is a liquid and got all the complications that go with it. So, one of the family office that backed me originally, one of the things he would say is, well, actually, why don't I invest in that value-add deal with tons of risk when I could, buy Ford's bonds at 8% and leverage that and get to a 10% tax-free return? I said, well, partly I'm not selling bonds for Ford, so that doesn't help me. But it's a fair point. I think real estate still, as long as you get your basis right, it still creates a very nice diversified income stream, generally a hedge against inflation, if you've done your job right. So yeah, it's definitely been a challenge for all real estate investors trying to attract capital to real estate in the UK in the last couple of years.
And from a business model perspective, it's still very much development, flip, buy, develop or fix up and then exit rather than hold.
It has been. We've actually retained a couple of assets that we've signed long-term leases on. And so, which has been nice because in the absence of a fund, those assets have created an income stream for the business, where on one particular asset, I converted it was meant to be a get in, get out deal. We then signed a long-term income stream, and the family office I did the deal with were flexible. They allowed me to convert my promote into a share of income, which now funds a lot of the business. So,
you touched on Mercer, a lawyer who's acted for you over the years as someone who's been really instrumental in terms of helping you with the business. Have you lent on others as mentors in an official or unofficial way? And I think you obviously touched a lot about Michael and Brandon, and obviously your father being in the industry. No doubt that's kind of been just been a phone call away just to ask and get his experience on things. But has there been anyone else specifically that you have listened to or seeked the advice of?
I mean, Martin, who works with me, he has got an amazing experience and track record in the industry. So I'm very lucky to have him in the office to spin ideas off, and he's been around the block a bit, so he gets it. There have been other friends in the industry when you're feeling lonely or you're questioning, your thesis on something, or a killer virus takes over the world and screws your whole business plan. So I'm lucky that I've got a lot of friends in the industry, and you compare notes and war stories, and so I wouldn't say there's been one specific mentor, although I would say the family office that backed me originally, the UBO of that business, was definitely as much a mentor as an investor.
Yeah, it's a kind of common theme that I think threads our whole conversation right from, I forget the professor's name, over
Peter Lindemann.
Peter Lindemann. And Anoush, is it?
Anoop.
Anoop. Yeah. It seems like there's these kind of characters or individuals throughout your career that, have been there at timely moments to kind of help advise or kind of lean on. So yeah, it makes a lot of sense. There's been a number of people who've set up businesses in the last few years, and I know that there'll be people listening to this who are currently employed somewhere who would love to set up their own firm. What advice would you give to someone who's either contemplating that or who's in the trenches right now, earlier on in the journey?
It's always very risky. There's a lot of people who say that you should keep doing what you're doing. You're very good at it. It's a safe spot. But there are moments, at least I had, where there were clear opportunities to do something, and jump and take the risk, back yourself. I also think the journey of where you want to get to is almost certainly not the one that you'll have, but that doesn't mean you won't get to the same place. It can be very nerve-wracking not figuring out that journey, and we all look at probably most of the people on your podcast, Matt, and think, how do I get to where they are? And it's normally a lot of twists and turns and luck, but probably the common theme is they took risk and they worked really hard.
Yeah, and just kept going.
Yeah.
So let's say I exit Rockbourne for many billions, and my allocation to real estate is 500 million. Who are the people, what property, and which place would you look to allocate that capital?
I thought you were going to give me a few billion there.
In time.
There's so many great operators in our market. If you sort of take kind of the risk-adjusted side out of that equation, you look at established people like Delancey, I talked about earlier. Jamie Riplat's built an amazing business. Pear's family office, they do phenomenal deals. They really understand risk and they've lived through it with their own money. A friend of mine there, Ben Grossman's done some amazing industrial deals, buying and then subselling and having a free income stream or ridiculously high yield. I don't think Delancey or Pear's need my money, so that there are lots of niche operators in the market who are great friends, like Hugh Williams, who used to work at Pear's, David and Max Freed, who have a development business in Bristol, Faris and Rakan McKinnon, who have a business called Landcap doing offices. So there's lots of talented people. And it's great working with friends. I'm lucky that I do work with a lot of friends. From a selfish perspective, to round up on that question, I'd love to invest some in core plus offices alongside the family office we're doing that with now. I'd love to invest in strategic land on a long-term basis for high multiples at the right basis. And I'm really excited about this defense infrastructure structure we're looking at the moment to try and create long-term income. The deals I talked about earlier where we have income, it's very nice every month just getting paid without having to take tons of risk and reinvent a business plan and refinance. And so that there would be a big place for just good long-term income in that 500 million.
And in terms of location across the UK?
Across the UK, it's the market I know. I think there are some great opportunities in Europe, in Spain and Italy in particular. We've done that office development in Dublin. Would love to do more in Dublin. So yeah, wherever the opportunity takes us.
Anthony, I really enjoyed the conversation today. It's been a real privilege to have you on the show, and it's been a couple of years coming to try and get you to this point. So it means an awful lot that you're here today. And I think, one of the takeaways, and as I said at the top of the conversation, as I love kind of profiling and platforming younger entrepreneurs on the show, is just that resilience, that drive, the fact that you've not waited for someone else to come along. You've actually been really, really proactive in terms of making stuff happen and put yourself in positions, whether that's the GRI or in the US or at the early days of Mercer with Brandon and Michael, through to setting up your own platform and taking the risk and taking those lessons. So, I think for those earlier on in the journey, there's an awful lot within this short conversation that hopefully they can reflect on, and there's definitely stuff that I'll be taking away. And I'm certainly very excited to see what you and the wider team go on to do for 2025, 26, 27 and beyond, and certainly won't be betting against your success. So thanks so much for joining me in the show. I've really enjoyed it and excited to see what you and the team go on to do.
Thanks, Matt, and appreciate you having me.
Hey, quick one from me. If you enjoyed this conversation, do me a favour and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.